Or let's unpack this. Today, we're doing a deep dive into something that is often on people's minds, generating passive income, specifically through real estate, but maybe in a way that doesn't mean you have to, become a landlord. We're focusing on a particular type of investment designed for just that, a real estate investment trust, or REIT. Our source for this deep dive is a recent Motley Fool article. It highlights a specific REIT they're recommending for passive income, like right now, in June. So our mission is to really dig into why this particular one caught their eye, understand its business model, what makes it tick.
Right. And what's interesting, as the source explains, is that a REIT is basically a company that owns a big basket of income-generating real estate. The fundamental idea is pretty straightforward. They collect rent, and then, crucially, they have to distribute a big chunk of that income back to you, the shareholder, as dividends. So yeah, we'll be focusing on the one the article identifies as a top pick for income folks.
And that specific company is VICI Properties. Now, right away, the article points out something a bit different about VICI. It says their focus is on experiential real estate. That already sounds more interesting than, say, office buildings or warehouses, doesn't it?
It absolutely does, yeah. And digging into the source, experiential real estate for VCI means owning these big destination properties, places people go for fun, entertainment, leisure, think market-leading casinos, yeah, but also hospitality, wellness centers, entertainment venues. The article mentions specific examples like the Venetian Resort in Vegas, huge one,
Yeah.
and Chelsea Piers in New York City, that big sports and entertainment complex. These are places designed to pull people in.
Got it. So they own these massive destinations, and their core business model, how they make money from them, is basically leasing them back to the companies that actually run the places.
Exactly. And this is where the passive income engine for VCI gets, well, particularly strong, according to the article. They use something called very long-term triple net leases, NNN leases.
Okay, let's break down that triple net or NNN part, because the source says it's really key.
It is. So the source explains that under an NNN lease, the company operating the casino or resort, they're responsible for basically all the property operating costs. We're talking routine maintenance, property taxes, building insurance, the whole lot.
Ah, okay. So it's kind of like renting a house where the tenant pays not just rent, but also the property taxes, insurance, and fixes the leaky faucet themselves.
That's a good analogy. For VCI, this structure means they offload those variable costs onto the tenant. It makes VCI's own income stream much, much more predictable. Less risk from fluctuating property expenses.
Predictable income plus longevity. That sounds like a good mix. The article highlights the average remaining lease term is, 40 years? That's incredible.
40 years, yeah. Astonishingly long.
And the rent isn't just flat for 4 decades, right? The structure has built-in growth.
Exactly. It's designed with inflation protection baked in. The source points out that rents increasingly escalate based on inflation. It specifically says 42% of their rents were tied to inflation increases this year. And that number is set to climb to 90% by 2035.
Wow. So the income is predictable, and it's designed to grow automatically, hedging against rising costs over time. That makes sense.
And that whole structure, long-term, escalating, triple net, that's really fundamental to their ability to pay and grow a strong dividend. The article pegs their current dividend yield at a pretty substantial 5.5%.
5.5%.
Yeah.
Okay, let's put that into perspective for someone focused on passive income. The source compares that to the S&P 500 index yield, which it notes is, under 1.5% right now?
A sub 1.5%.
So yeah, 5.5% is more than 4 times higher. That's a big difference if income is your main goal.
Definitely stands out. And it's not just the current yield that's noteworthy. It's the growth of that dividend, too. The article points out VCI has actually raised its dividend payment every single year since it was formed. That's 7 years straight.
Every year. And the growth rate?
An average compound annual rate of 7.4%.
7.4% average growth per year. That's solid.
It really is. And the source emphasizes this by comparing it to the average pace for other triple net REITs. It says their average has only been about 2.3%. So VCI's growth has been significantly faster. Suggests a particularly effective engine there.
Okay, so strong yield, strong growth. But can they sustain it? What about their financials?
Good question. The article suggests their financial health is solid and supports this. It notes VCI pays out about 75% of its adjusted funds from operations, FFO, and dividends.
Right. FFO, that's like the key cash flow metric for REITs, isn't it? Adds back depreciation and stuff.
Exactly. So paying out 75% gives you that high yield, but importantly, they're keeping about 25% of that strong cash flow back.
And retaining that cash is crucial for, investing in new properties, future growth.
Precisely. It fuels future investments. The article also mentions their balance sheet strength. They have a solid investment-grade credit rating, and their net leverage ratio, basically debt relative to operating income, was 5.3 times. The source notes this is right smack in their target range of 5.0x to 5.5x.
Okay, so they're managing their debt comfortably within their own targets.
Yeah.
That signals financial discipline.
Mm-hmm. Gives them additional financial flexibility to chase those new opportunities.
Right. And that combination retained cash flow plus balance sheet capacity lets them look for growth. The article talks about their current portfolio. It sounds impressive already. 54 gaming properties.
Yeah, including 10 really big ones, trophy assets, right on the Las Vegas Strip.
Plus Chelsea Piers and those 38 bowling centers leased to Lucky Strike.
Right. But the article makes it really clear there's still a huge runway for more growth.
Okay, like what avenues does it mention?
Well, first, just in the gaming space alone, it estimates there's something like $400 billion worth of U.S. gaming properties that are not currently owned by REITs or tribal companies.
$400 billion. Wow, that's a massive potential market just for acquisitions.
Huge pool. Then it specifically calls out tribal casinos. VCI is already working with tribal operators, owning properties leased to them, making loan investments. It mentions a partnership with Red Rock Resorts for a new casino resort development, so that's another big segment.
Okay, gaming, tribal gaming. What else?
And then there's the move into non-gaming experiential properties. The source highlights their strategy here. They're forming financial partnerships, making loans to operators in other experiential sectors. Think Great Wolf Lodge.
Oh, yeah, the water park resorts.
Exactly. Or Canyon Ranch for wellness, Cabot for golf resorts.
So they're lending to these types of businesses.
Yes, but what's really interesting, according to the source, is that many of these loans include options for VCI to potentially buy the property later through what's called a sale-leaseback transaction. So a loan could eventually turn into another long-term triple-net lease asset, just like their core property.
Ah, that's clever. A pathway from lending to ownership.
It seems like a smart way to expand their footprint. And they've even got a strategic relationship set up with Kane International and Eldridge Industries, specifically to find these unique, high-quality experiential opportunities outside of gaming.
Okay. Any examples of that in action?
Yeah, the article gives a concrete example. Their first investment through this partnership, a $300 million mezzanine loan for a project called One Beverly Hills. The source describes it as this luxury mixed-use development, an all-suite Aman hotel, high-end shops, fancy restaurants, even botanical gardens. Sounds very experiential.
Definitely fits the theme.
Yeah.
Okay, so when you pull all that together, the stable growing income from those long-term inflation-linked leases, the financial strength pertaining cash, managing debt,
Right.
and these multiple clear pathways for future expansion that the source details.
It all directly feeds into their ability to keep growing that dividend payment for shareholders over the long haul. That's the connection the article makes.
Got it. So connecting this back for you, the listener interested in passive income. The article basically wraps this up by calling VCI a high-quality, high-yield income stock.
Right. It highlights that attractive yield, the steady dividend growth, the stable cash flow from those really durable NNN leases, plus the solid finances and all those different ways they can keep growing.
And that's the core argument for why the article identifies VCI Properties as a, quote, top REIT to buy for income this June. It's presented as a potential way for you to collect quite a bit of income now, with a clear path for that income to potentially grow quite a bit more in the future.
Makes sense based on the points they lay out.
So we've done a deep dive today into VCI Properties, really unpacking its unique focus on experiential real estate, the strength of that triple net lease structure, the dividend story the source tells both yield and growth.
Its financial stability, and those various routes for future expansion.
Yeah, quite a comprehensive picture from the source.
It really is. And maybe a final thought for you, the listener, to consider as you look at income investments. If understanding how a company structures its income streams, like VICI's long-term inflation-linked triple net leases, is so important for judging stability and income potential, what other specific details, maybe structural elements or contract types, in different kinds of investments might give you similar clues about the reliability and growth prospects of their income streams? Something to think about.